China just did the unthinkable. It borrowed dollars at the same rate as Washington, and investors lined up with $65 billion in bids. That same week, Nvidia froze all chip shipments to China after Trump's new ban, and Beijing didn't blink. Within days, Huawei unveiled a rival processor built entirely with Chinese parts and sold it out overnight. The message was brutal. The dollar and the microchip, America's twin empires, are both slipping. So, Bloomberg confirmed that demand came from sovereign wealth funds, insurers, and central banks, precisely the buyers who once underwrote U.S. debt auctions. And as the Financial Times added, the 3-year tranche priced on par with U.S. notes, while the 5-year carried only a small premium. Remarkably, Beijing's cost of dollar borrowing had collapsed to parity. For investors watching U.S. auctions struggle to clear, the contrast was, well, brutal. But who was really buying, and why now? You see, the U.S. Treasury's own numbers told a different story. As of early November, Washington was preparing to refinance $125 billion in 3, 10, and 30-year debt, Bloomberg wrote. Primary dealers demanded higher yields, auction tails widened, bid-to-cover ratios slipped. Interestingly, the government that issues the world's reserve currency was paying a risk premium. According to IMF data, U.S. gross federal debt is nearing $39 trillion. Servicing costs now exceed $1 trillion per year, more than the Pentagon's budget. By contrast, China's central government debt remains below 80% of GDP, and its inflation rate hovers near 0.3%, the National Bureau of Statistics reported in October. Low inflation lets Beijing issue bonds aggressively at low rates, reinforcing confidence in its monetary discipline. China's Ministry of Finance announced simultaneous domestic purchases of 20 billion yuan in sovereign bonds, a liquidity injection aimed at lowering long-term yields. The People's Bank of China backed the move with reverse repo operations to keep short-term funding smooth. The sequence showed coordination between fiscal and monetary policy, a luxury Washington lacks while Congress remains divided over spending caps. Because borrowing cost decides who controls the next decade. Reuters data from August showed China's holdings of U.S. Treasuries falling to $756 billion, the lowest since 2009. Japan and the UK increased holdings, but much of that flow was custodial. Chinese banks were quietly trimming exposure. The US still depends on foreign buyers for roughly 1/3 of its treasury demand. A gradual Chinese withdrawal forces higher yields across the curve. Bloomberg Intelligence estimated that each $100 billion drop in foreign treasury ownership adds about 12 basis points to average US borrowing costs. That does not sound large until multiplied across $28 trillion of marketable debt. By late October, the U.S. 10-year yield touched 4.95% near a 17-year high, while China's equivalent fell below 2.2%. The yield gap, once a magnet for foreign capital, now implied global investors saw equal or greater safety in Beijing's bonds. Financial Times analysts noted that after Washington froze $300 billion in Russian reserves in 2022, central banks from Brazil to Saudi Arabia began diversifying reserve portfolios. Gold purchases hit record levels, and allocations to Chinese debt climbed. It's about optionality, said Zoltan Pozar, founder of Exuno Plurus. If you fear sanctions, you build your own plumbing. Bloomberg data showed that the People's Bank of China has expanded bilateral swap lines to $580 billion across 40 countries, a quiet architecture for yuan liquidity that bypasses the dollar. In 2025 alone, Argentina, Pakistan, and Indonesia drew on those lines to stabilize currencies. Every transaction settled without touching U.S. banks. China's financial footprint widened again in November when Beijing priced a €2 billion bond in Paris. Under its new Panda Euro framework, European institutions bought more than half the issue, signaling confidence in UN-linked assets despite U.S. diplomatic pressure. Meanwhile, U.S. corporate borrowers faced rising distress. S&P Global Ratings reported that U.S. corporate bond defaults in 2025 had already surpassed 2020 levels. High yields meant refinancing risk for firms that relied on cheap money through the pandemic era. When risk-free rates soar, junk spreads follow. Among the hardest hit sectors was technology. In Shenzhen, Huawei and BioNTech responded by launching new AI accelerators built entirely on Chinese designs and supply chains. Bloomberg Technology wrote that Huawei's Ascend 910B processors now match Nvidia's previous generation A100 chips on efficiency per watt, closing a gap that once looked insurmountable. Beijing's Ministry of Industry announced plans for $40 billion in additional semiconductor support through state banks and provincial funds. That same week, China's State Grid Corporation reported a record 9.2% year-on-year increase in industrial power use, evidence that AI and manufacturing build-outs were accelerating despite export controls. Energy subsidies for strategic sectors kept electricity prices near 6 US cents per kilowatt hour, versus an average of 17 cents in the United States, according to the IEA. Because every dollar China stops buying costs Washington billions. Production cost and energy access determine who dominates the next hardware cycle. Cheap energy and patient capital let China scale where US firms stall. The contrast extended to AI finance. OpenAI disclosed in a regulatory filing that its planned data center expansion could require up to $5 trillion globally over a decade. Analysts at Morgan Stanley called the model mathematically untenable given current cash flows. With treasury yields near 5%, debt financing for such projects became prohibitively expensive. Bloomberg reported that OpenAI had approached US authorities for credit backstops similar to defense contracts. A sign that Silicon Valley's AI boom was colliding with public finance constraints. If the math doesn't add up, what keeps the bubble inflated? By contrast, Chinese AI consortia in Guangdong and Chengdu secured low-interest loans from state banks at rates below 2%. The National Development and Reform Commission tied these credits to infrastructure objectives like grid modernization and heat recycling. Capital costs became a competitive weapon. Labor markets mirrored the strain. The Challenger report recorded 153,000 U.S. job cuts in October alone, the worst month since the pandemic. Manufacturing payrolls declined for a fourth straight month. Reuters linked half of those losses to interest rate-sensitive industries like construction and tech. When credit tightens, projects freeze, and employment follows. At the same time, China's jobless rate edged down to 5%, with industrial output rising 5.2% year over year. The National Bureau of Statistics attributed the gain to export growth in electric vehicles and batteries, up 70% since January. Those exports carry high-value content and reinforce yuan inflows that offset any loss from reduced treasury holdings. Bloomberg calculations showed that China earned a record $1.3 trillion trade surplus in the 12 months to September. Each surplus dollar creates a choice: recycle into U.S. debt or deploy through Chinese banks abroad. Beijing increasingly chooses the latter. That diversion reduces demand for new U.S. issues and, raises Washington's cost of capital. The Financial Times quoted strategist Paul Donovan of UBS as saying, "Every bond China doesn't buy is a bond someone else must buy at a higher yield. Markets price that absence instantly." By mid-November, foreign participation in U.S. Treasury auctions had fallen to 12%, the lowest share since 2011. Primary dealers, the banks obliged to take what's left, held record inventories of unsold debt. Bloomberg Markets called it a slow-motion buyer's strike. Bloomberg Opinion noted that the dollar's share of global reserves has slipped to 58%, the lowest in 25 years. The euro rose to 21%, the yuan to nearly 5%. IMF analyst Serkan Arslanalp described the trend as steady erosion rather than revolution. But erosion is what brings walls down. Inside China, policy planners are capitalizing on the moment. The finance ministry has approved pilot projects allowing foreign issuers to list yuan bonds on the Hong Kong exchange under streamlined rules. That creates a mirror market to London's Eurobond scene of the 1970s. Once investors get comfortable with the plumbing, scale follows. At a Beijing forum in October, former SAFE official Guan Tao said, "The goal is not to replace the dollar overnight, but to ensure China never depends on it." His comment captured a strategic shift from accumulating U.S. assets to building alternatives. Meanwhile, U.S. data centers are hitting a power wall. The Energy Information Administration projects AI-related electricity demand in America to rise from 17 terawatt-hours in 2023 to over 150 by 2030. Grid upgrades lag behind permits, and construction costs have surged by 30% since 2021. Without cheap energy or credit, the AI boom becomes a cost crisis. China has the opposite problem, a power surplus from hydro and coal. Bloomberg NEF estimated that unused industrial capacity could supply AI clusters worth $200 billion in GDP by 2027. The same factories that once made solar panels are being repurposed for cooling and computing hardware. In Washington, the political response remains, fragmented. Congress is in the midst of debating a debt stabilization act that aims to cap interest costs at 3% of GDP. However, analysts are warning that such ceilings might be unenforceable when, markets are the ones dictating rates. The Wall Street Journal has reported that foreign policy aides are privately fearing that Beijing could stage market pressure tests by timing bond issuances opposite U.S. auctions. This could be a way to drain liquidity without, firing a single shot. Now, if that sounds a bit theoretical, consider what happened on November 8th. China's $4 billion issue in Hong Kong closed books within just a few hours. Meanwhile, the U.S. Treasury's $42 billion 10-year auction the next day cleared at the highest yield since 2007, and with the weakest foreign participation on record. Markets, of course, noticed the timing. Economists over at Nomura called it a stress test of dollar credibility. Investors were demanding a premium for U.S. risk. Not because they feared default, but because Washington's politics made forecasting policy nearly impossible. By mid-month, the Chinese yuan was holding stable near 7.1 per dollar, defying predictions of a slide. Thanks to capital controls and steady trade surpluses, confidence was anchored. Beijing had, it seemed, found a way to neutralize the dollar weapon without actually abandoning it. In this kind of environment, Treasury Secretary Scott Bessent is facing a paradox to defend the dollar. He has to sell more of it. Each new issue feeds into the very market that China no longer needs. And as global investors rebalance their portfolios toward Beijing's paper, Washington is finding itself paying a premium just to preserve its prestige. If China no longer needs Washington's permission to borrow in dollars, well, who really owns the system now? We're glad you're enjoying this video. Please like and subscribe if you haven't already. And hey, check out another video that is now on your screen.